P and the E. Welcome
Yes.
to the world, Omar Najia. The P
Let me
has
just
been
ask my
going E.
colleagues. Randoor, IP is now IE? No, fucking
Yalla.
way.
Welcome, everybody. Good morning. It is Monday, February the 20th, where International Petroleum Week got redesignated as IE Week, where Oil and Money got redesignated as Intelligence Forum, where ADIPEC is still ADIPEC nonetheless. I wonder, will they do something with that P? We see oil prices trading in Asia this morning a little bit up after some sort of declines at the end of last week, with Brent now trading at 83.60, up nearly 1%. Again, they're stuck in this pretty tight band. This is the week, of course, when we have the first anniversary of Russia's invasion of Ukraine, with all the turmoil of the world that has triggered over the last 12 months. What will it deliver over the next 12 months? Let's start off this morning, as always, with Omar Najia, Global Head of Derivatives at BB Energy. Omar, have you seen anything in the last week that gives you sense that this market can find direction now?
Well, I think that directionally the markets want to head or will head lower. The question is from what level? Is it from here? Is it from higher? But I think they want to and they will head lower. The only, so I'm actually bearish. So we've been kind of negative on oil. We're negative on equities. We're pretty negative on everything. But how long this market can basically levitate is anybody's guess. If you look at the market from the beginning of the year, in fact, from December till now, it hasn't really done anything. It moves, WTI moves from about 72 to 82, back to 72, back to 82. So it keeps doing that. So at some point, it's going to break. Either it breaks 82 to the upside or it breaks 72 to the downside. But for me, if you look at it and you say, are we going to set new highs? And by new highs, I mean new all-time highs. So 130, all that kind of stuff. Or are we going to break, $60 on WTI? I think the breaking of $60 is a lot more is a lot more likely. Even equities, I can't bring myself to kind of, put money into equities and say that, we're going to revisit the highs and take them out and just keep going. There seems to me some kind of, moment of reckoning that's going to come. But again, the difficult bit is always, when. And analysis doesn't lend itself to, next Thursday at 5 o'clock. It looks at basically lower or higher, but it doesn't tell you at what time it's going to go and all this kind of stuff. So directionally, strategically, we are bearish. When that happens is anybody's guess. So I think, if we break, let's see what happens this week. If we manage to break below the lows on Friday, if we take out that $72, it could really start to go in a big way.
Let's go to Asia with Clyde Russell, Asia Commodities and Energy columnist at Thomson Reuters. Clyde, we did have the OPEC and IEA both last week indicating that demand recovery in China is going to be greater, bigger, more than previously expected, faster, and so forth. Do you see that from your perspective? Will China be the one to give this market the breakout direction?
It's interesting. I think there's actually probably a fair chance that China's demand does rise. I think, the figure of 500,000 barrels a day to 1 million barrels a day is not an unreasonable expectation if we actually expect that China's economy will rebound, that they get the stimulus right, that consumer spending comes back, and that the rest of the world doesn't slow too much, thereby hurting their export industries. All those assumptions, if you say those are reasonable, then I think a 1 million barrel a day increase in Chinese demand is reasonable. The point is, everyone bakes that into a 1 million, barrel a day rise in imports. And that's where it's not necessarily the case. A lot of it depends on price. If the price does break up higher, you sort of get $90, $100 a barrel on Brent, the Chinese will just simply use their inventories. They've done that in the past, they'll do it again. So they were already importing, almost in last year, 700,000 barrels a day more than what they consumed. So their stockpiles of both crude and of products are fairly full at the moment. That gives them a nice cushion. The thing is, the Chinese don't talk about this. They don't talk about their inventory levels. It gets very little media attention. But the simple fact is, if they deem prices to have risen too far too fast, they just tend to stop importing as much. I mean, it's not like their imports collapse, they still import, but the idea that they'll be importing an extra 1 million barrels a day if the price goes up above 100, that might be fanciful. So if I'm looking at the whole sort of thing, I think the expectation is it's reasonable that Chinese demand will go up, possibly by as much as 1 million barrels a day. That does not mean that imports go up by 1 million barrels a day. It all depends on price.
Do we even know how much China's importing, Clyde? Your own Reuters reporting indicates that the Chinese Ministry of Commerce is reaching out to the independent refiners to ask them, how much Russian oil are you actually buying? We don't know. Does anybody know what that number is for you to make an assessment that imports will or will not be more?
Well, I think what we've seen in the last couple of months of imports have ticked up. I mean, if you look at all the sort of tanker tracking services, Refinitiv included, Kpler, those ones that I look at certainly are all saying that imports have kicked up. They haven't yet reached much above, 11 million barrels a day. Certainly, they are taking a lot more from Russia. You've got record imports from Russia, we think, in January. So, certainly a lot of the extra oil that China's sourcing is coming from Russia. How that plays out on demand from the rest of the coal on the rest of OPEC Plus and that, it remains to be seen. My sort of seeing is, at the moment, Chinese imports at our best to be slightly higher than what they were towards the end of last year, but more like steady. That doesn't mean that you're going to not see, come like May, June, July, a big tick up. We do know that the physical market works with a lag. So if you're expecting Chinese imports to rise, that's not going to happen for a couple of months. But what I'm actually hearing from the trade is that people are not seeing the Chinese going out and buying massive amounts of crude. In fact, they're kind of seeing the opposite. They're sort of staying away from the sort of higher priced Saudi grades.
Well, why wouldn't you when you can get Russian at $20-$30 a discount? Why would you be buying anything other than what you're contractually obligated to buy? Richard Radoglia, CEO of Matrix Global Holdings, sitting in San Diego, lovely San Diego, California. You guys are defying gravity there in the United States. You've got a bumper economy. I'm not sure why Omar is so. He loves Disney. They're making great movies. They're making huge profits, full employment. You're making more jobs than God. This is a bumper economy. Oil prices are only going one way. What's your thoughts, Richard?
I think there's really a broader story here, and I don't know where prices are going. I thought they were going to break higher. They broke higher, then they went back down again. So I'm not really sure where prices are going. But I do think there's a much broader story. It doesn't lend itself to a definitive answer. And I know a lot of this, you have to, Sean, as you're coming on, where the price is going to be in the immediate. But I'm kind of looking a little longer term here and thinking, really, we're coming out of two black swan events. We had COVID, which had a major effect on demand, and the Ukrainian war, which had an effect on supply, and more importantly, had an effect on flows. And I think those flows are very important. Clyde made a very good point earlier before we started about how the market adapted to change and how it adapted to the flows. And I had made a comment. I think information is so relevant or so prevalent now, the ability to make decisions so quickly, that commodity traders are smart people, and they do the right thing to make things happen. But I was wrong about the war in Russia. I thought there was no way that Russia was ever going to invade them. I think Omar, I'm not sure Clyde felt, and they did. They invaded them, and here we are, a bit later, and we've got through it. But what I'm amazed at is how the U.S. and the EU are taking both COVID, and they're taking the war to push the transition. Let's get on with this transition. Let's get this thing going. This obviously, having your supply of energy from a country that's a dictatorship is a problem. What are we going to do about it? Let's get this transition going. And I guess that's where the problem I have is. It's not right now. It's not the next 6 months. It's the next year to 4 years. What is going to happen to energy over this next 4 to 5 years, if demand goes from 101 to 102 to 105 to 108, I think it's going to be winners and losers. The winners are going to be
Well,
refiners.
there's a flip
right?
side to that narrative, and that is, I don't know how many times Joe Biden needs to bang down the table, please pump more oil, and Houston and Texas are not looking to pump more oil.
Well, the banks aren't giving them the money. The banks aren't lending them the money either.
You've got $80 billion of profit.
Okay.
You could buy the bank. Who needs a
Yes.
bank when you got $80 billion
Yes.
of profit? They rushed it out the door to get it to you and your other pension funds now that you're near retirement, but not quite there. Omar, looking ahead to the week that's in it, I mean, black swans and so forth. The first anniversary of this war is coming up at the end of this week. I myself am flying to London to IPIE week on Friday. To be honest, I'm a little bit nervous flying anywhere near that geography because I think things are going to get a little bit explosive beyond what we've seen. Your thoughts on where this war goes vis-a-vis its impact for the energy markets, or any at all, as the energy markets completely priced it in?
Yeah, but I totally agree with Richard on shale. They're not giving them the money. They're not going to get the money ever. They get the money when money's worth nothing, when it's basically 0% interest rates at 4.5% Fed funds rate, and probably going to peak somewhere at 6.5%. You can absolutely forget about them getting a penny. Absolutely forget it. They don't make money. It's cheaper for you to invest in treasuries than to give these guys money. They have massive loans that they can't pay back. Anyway. In terms of the war in Ukraine, I think basically my narrative is slightly different than what you see and what you read and all this kind of stuff. So my take, unbelievable as it is that the West is actually panicking now. So if you actually see the speeches that happened in Munich, the tone has gone from last year, which was a kind of Trump, here we go, da, 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 and we're going to destroy them, the sanctions, I don't know what, blah, 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 to this time, the mood is a lot more, quote unquote, somber, it seems to me. And, all this talk about, we're going to send them tanks and we're going to send them planes. And they've sent them tanks and they sent them, all kinds of stuff. And it's made zero difference. So this war, everybody keeps talking about it. Now NATO's talking about it. It's like an industrial war, right? So the US is used to fighting, very limited kind of battles with goat herders and, using special forces and a couple of tomahawks and all this kind of stuff. This is a war with near peers that fire basically 60,000 shells a day, 60,000. So I'm sure you've seen in the news that NATO's saying we can't make as many.
But
shells.
Let's just get to where we think this goes for the energy markets vis-a-vis. Is it escalation? Is it?
So yeah, it's escalation. It's not going to end. This is basically whoever wins this war, whether it be Russia or NATO, is going to basically smack the other guy big time. So if Russia loses, it'll be dismembered completely. It'll be basically, if Russia loses this war, I believe the S&P will absolutely fly. But if Russia wins this war, so why? Because basically commodities become really cheap. Commodities, all kinds of commodities, become basically worth nothing. Dollar stays king. You give exporters, Australians included, US dollars for real commodities, and that goes on as it's been going on for the last 50, 60, 70, 80 years. And so S&P explodes to the upside. You buy energy really cheaply. You buy metals, you make cars, all this kind of stuff. But I don't think that's going to happen. I think what's going to happen is Russia is going to basically win. And I think basically that's going to mean that, the S&P and all the rest of it gets crushed because commodities will set new real values, which will mean that, the West, which is used to buying commodities cheaply and then basically using them to manufacture stuff and selling those cheaply, that kind of leverage will be gone forever. So I think the war in Ukraine keeps going because it's so important for either side to win. I think they will continue to escalate. And I think, the losers is going to have hell to pay. And I think if Russia wins, then you're going to see countries come out of NATO. You're going to basically see, this kind of thing where Seymour Hersh saying that, the Americans blew up Nord Stream. I think it's going to cause chaos. So there you go.
There you go. Chaos, more chaos. Clyde, meanwhile, the profit to be made in refining in Asia is collapsing everywhere. Never mind in Asia, but nonetheless, you have an article out today about the impact that China is having in the sort of Asian spreads. Could you just talk us through there what your outlook for Asia refining and China sort of dominating into this opportunity, and where Russian cheap crude or cheap products now are impacting the Asian market?
Well, I think what we've actually seen in the last couple of months is China's come back into the product markets in Asia, having largely sat them out in the first half of last year. It gradually started coming back in the third quarter, came back more in the fourth quarter, and that's continued so far the first 2 months of this year. What that actually is doing is, yes, it stokes Chinese crude import demand, because they then are exporting more products, so they're importing more crude to refine it. But it also impacts on the supply of the product markets. So we've seen the profit on making diesel in Asia has gone from a peak of something like $75 a barrel down to just around 20. So there's been a tremendous coming off there. I mean, let's be honest, at $20, it's still quite high by historic standards, but the sort of heat has come out of that market. So as long as the Chinese are importing cheap Russian crude, refining it and selling it into the product markets, you're going to see, that sort of dynamic take hold. It means also, I think, that the world can probably withstand the loss of a certain amount of Russian products from the market. I do expect that, similar to crude, Russia will be able to sell quite a lot of its products, albeit steeply discounted. They won't sell it to Europe, they'll sell it to other people. A trade that we're starting to see is a lot of Russian diesel and fuel oil going into the Middle East. What that basically means is countries in the Middle East can use that Russian diesel in their domestic markets, i.e. run their own vehicles on it, and then they can export their own diesel that they had been using domestically, sell it into Europe, and it's compliant with the European sanctions. So that's the kind of trade that you're seeing going on. Who is a beneficiary of this? Well, in some ways, you can say Russia is a beneficiary in the sense it still gets to sell some stuff, but it has to take big discounts. So they are losing in that sense. The winners are China, India, and any other country in the Middle East that can import the products and the crude and export products out and make a mozza doing it. So that's kind of how that dynamic is changing, and that's
how
what
does
I'm
that
seeing.
get impacted as China recovers? Do we see less Chinese exports of products?
Well, there is that possibility. What you've actually seen is Chinese gasoline exports come off a little bit as, that first part of their economy to recover was basically personal transport, therefore gasoline for cars. So you've actually seen them export less gasoline as they've been using more domestically. The diesel's still lagging a bit. We could assume that Chinese, as their economy kicks into gear, as you get more construction, more infrastructure spending, all those diesel heavy sort of activities, that they'll start to use more diesel. Well, then that's where you come back to will they import more crude to continue exporting into the product markets? And the answer is quite possibly, if they can make money doing it. I mean, part of the reason they're out of the gasoline market is that, the gasoline profit margin fell quite a lot. It's recovered subsequently as China's exported less. But basically, the Chinese refiners left gasoline because they were selling it domestically and making more money. Right now, they're still making a lot of money selling diesel. If they continue to make money, that's what they will continue to do. And I think Beijing's made it quite clear that they're going to allow the import of crude and the export of products as long as it makes economic sense.
Richard, the other big story that seemed to emerge over the weekend again was this idea of 50 basis points. We had sort of early had, it seemed, put to bed, at least the market had, maybe more wishful thinking. Inflation was gone. We're on 25 basis points, one or two more, and we're done. Now we've got all of the data indicating inflation's hanging around for a while, and some Fed officials talking 50 basis points. Where do you see that going, and the appetite and ability of the economy in America to absorb longer and higher rates?
I think it's going to have to. I think, one of the things I had said earlier, I think on a prior podcast was, we had cost push and now we're into wage pull, right? It's very much people need to be paid more money. In California, it's really expensive to live. The rents are up. Everything costs more. A carton of eggs is costing a lot of money. When's the last time someone talked to you about how much a carton of eggs cost, right? It's a topic of conversation. And I think that's really puts us in a situation that the Fed has to do it now. They cannot start backing away, no matter what. They realize where they're at, and we're going to continue to see wages just continue to move higher. I mean, there's no way around it, really. That you have to continue to try to stop inflation where it is. I believe they came out of conversation came out today about making the target rate 4%. Well, it's the rule of 72. So now the dollar halves every 20 years instead of every 30 years. It's really getting to the point where we've put ourselves in a very difficult position. We printed tremendous amounts of money. The Inflation Reduction Act, as we all know now, is not an Inflation Reduction Act. It is a Climate Change Act, and that Climate Change Act is spending lots and lots of money. For everything. It's for the building of everything, and it's union paying jobs. So I think where we're at with the Fed is a situation which they're stuck, and they know they're stuck, and I think they're just going to continue to have to do something about it. So there might be 25 here and 25 there. The fact that they're going to stop, when they stop, I would imagine you see a strong rally in the market and then a dump, because I think people are going to realize they're going to have to come back in again and cut again, or raise again. It's just
again,
we are in a very, very difficult position.
And if you don't, I mean, you've got the echoes of the 1980s here. If you back away too early from inflation, you have to come in and double down even higher.
And we're going to see it in our. I'm not sure you're all aware, but our energy prices are really making another move to the upside now. It's moved away from gasoline. Gasoline was the big story. That was the release of the SPR. There's no more release of the SPR now, right? We have a House that's Republican. They're not going to allow. Well, who knows what they can allow? Presidents can do whatever they want now, but we're not going to allow that.
The US to default.
They can well, let's not go down that path. I mean, they could allow them to default, but they won't. But the bigger issue is what we're seeing on the utility bills. I mean, it's now your home heating bills are going through the roof, and so there's a real problem that we face here in the States, that the middle to lower class is going to get really hit hard as we kind of go into this next round, with inflation taking a bite, not just out of your pocket, but at the market, but also just the normal utilities around your home.
I mean, if you look at the opportunity here for Russia in the second year of the war coming to weaponize oil further, make larger cuts on oil while still getting discounted oil and oil products to all of the countries that you don't want to hurt. If you're Russia, it seems to me that has to be an inevitable outcome of year two, more weaponizing of oil exports from Russia. Let's get the survey question here. This is my dilemma. What is more likely to happen in year two of Russia's invasion of Ukraine? War spreads beyond Ukraine, or war ends? What is more likely to happen in year two of Russia's invasion of Ukraine? War spreads beyond Ukraine, or war ends? We had news over the weekend, or not new, well, news, I suppose, whether it's true or not, we'll have to see, that China now is on the verge of perhaps crossing a line of supporting militarily the Russians in their efforts, in their war effort. That would, I think, be a significant shift in the global geopolitical picture. Omar, as we move forward now in this week, your outlook, obviously that we've got some big geopolitical noise in the coming days, lots of big speeches. Does anything in the immediate shift this oil price range out of its current sort of stuckiness?
No, so basically what Richard was saying, I think I'd agree with. So there doesn't seem to me to be sustainable upside in whatever market you want to consider, be it from oil or be it from, equities. I don't see it. Debt's too high, interest rates are too high. You've got war in Ukraine. I'm not basically hopeful, but people are paying through the nose for everything now. You've got inflation. I'm not hopeful. I mean, you can put your money away for a year or two and earn 5%. Why should you take any risk at all, buying any company? I mean, to me, it just seems like, and nobody keeps, the 2 and 10 year rates, basically. Yeah, the curve has been inverted, but the biggest inversion since 1981. I mean, I remember when people were saying that it doesn't matter how much money we print because this is a new kind of thing and we can just print and print and print and print. And they kept printing, right? And everybody was like, yeah, but look, nothing's happened. And then, there's always a time where the bill is going to get paid. It's like you go to a restaurant, you keep eating and eating and eating. Oh, it's great, more wine, more this, everything's fine, And then you're going to get the bill. You can delay it and delay it. You're going to get the bill. We're going to get the bill. So
or you're going to wash the dishes.
Yeah, or wash the dishes for a very long time. So I'm not a bull. I'm just, I'm not at all a bull. And geopolitically, I mean, it's just amazing. You see, before people used to say like, China cannot support Russia and all this kind of stuff, but nobody used to come back and say, but hold on, every single country in NATO and the G7. Japan included, Australia, you name it. They're all helping Ukraine. They're sending them arms. They're using NATO satellites for targeting, for picking, for doing, blah, 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 blah. Man, the world has changed completely. That narrative that used to be even Macron over the weekend was blaming Russia for neo-colonialism. I mean, I think they've gone off the deep end. It's just that this kind of... Yeah, there's so geopolitically, I think it's a mess. Economically, I think it's a mess, and we're not bullish.
Clyde, looking in your crystal ball as you do every day beyond the energy markets, right across the commodity complex, do you see anything else in any of the other special crystal balls that gives the energy market some cuckoo in the coal mine sort of indications as to where things may be moving?
Well, I think actually the surprising thing is 1 year after the Russian invasion of Ukraine is how well the world has basically adapted to everything. You've seen a massive realignment in crude products, but also coal, LNG, natural gas, all this kind of stuff. And it's all actually kind of worked. Prices are now more or less back to where they were pre-invasion for most of the energy commodities. Some are lower, some are still a bit higher. The world has adapted and sort of moved on. I mean, it's hard for me to make a call as to who's going to win in Ukraine and Russia. I have a feeling that nobody wins. What I can think of is I think it's very much in China's interests that things continue pretty much as they are, i.e. stalemate. Because what is China getting out of this conflict? Not much political pain and a hell of a lot of cheap energy. So the longer this goes on, the longer the Russians are forced to sell their stuff at steep discounts, the better it is for China, the better it is for India. So they actually, their interests is in maintaining a stalemate. And I tend to think when the interests of a lot of people are maintaining a stalemate, you could even say the Western world gets something out of the stalemate. It weakens Russia over time. That's what's likely to happen. You just carry on with a stalemate. And it's terrible for the people on the ground, for the meat grinder of what's turning into a World War I type scenario. But that's kind of where I see things going, unless some side is prepared to commit absolutely massive resources to win. And I don't see that as likely. or possible.
Richard, last word to you with the survey result. I mean, clearly, as Clyde articulates there, so war spreads beyond Ukraine 60%, war ends 40%. I think we'll put that on social media to see where a wider circle of people's opinion on that is. But ultimately, it is, I think, the big question that as you ramp up the resources of this war in terms of hardware, the potential of spreading, I think, grows. I think there's a cuckoo in the coal mine recently with the collapse of the government in Moldova. I think there's something going on there that may be concerning. But Richard, the idea of where the US goes at this time, the US is a big winner. I mean, China's clearly a winner, but the US has been a big winner of this conflict. They've secured the European energy market. They're selling lots of weapons. I mean, at the end of the day, they're giving money to Ukraine. No, they're buying weapons off US military manufacturers that they give to the Ukrainians. So it's not like the Ukrainians are getting that money. People who make this stuff in wherever they make it in America get the money. But right. My question to you ultimately is the sustainability of the US support for this war as it goes into year 2.
I think that the media is behind Biden. There's enough Republicans behind Biden. So you have the McCain faction, the Lindsey Graham faction on the Republican side. They're war hawks, and they always will be. When you say that the military that the government is buying it, Richard Oley is buying it. My brother's buying it. American citizens are buying it. They're using our tax dollars to buy it, or they're printing money. So we've got this dual battle going on here. And again, I said in the very beginning, what's interesting is they're using this war to push the transition. So because we talk about energy our whole lives, they're pushing this to be a transitional. Let's use the war. Let's use this as a reason to get off hydrocarbon. It's not IP week anymore, it's IE week. And so I think what we have is this sustainability that we're not going to get away as long as the Democrats, as long as not just the Democrats, the Republicans who support the war are in power, we're going to continue to fight and push back and support Ukraine. The problem I have is that they're doing it to the detriment of the general population of the United States. Biden said yesterday, we are going to give money to the Ukrainians to help to buy food and to pay the pensions of Ukrainians. That is what he said, pay for the pensions of Ukrainians. How's that work? Where's that money come from? This is very, very, very difficult situation we're in. But I don't think we're
$31 trillion of U.S. sovereign debt. What's another trillion there in the printing presses?
Sean, one day it does have to end. We just don't know when that day is. So
as Omar said,
that was a very flippant 1 trillion. You used to say 1 billion. Now you say 1 trillion.
1 trillion, and as Omar said, that at some point the waiter comes out with the check. And the kitchen is overflowing with dishes. There's no room in the kitchen to go in to wash the dishes because there's so many dishes. We're gonna have to wrap it up there this morning, Monday morning. Really great to have you guys. Top panel as always. Omar in Dubai, Clyde Russell in Australia, Richard Ugoga in California. We look forward to seeing everybody every morning at 10:30 UAE time. Will Brent break out of this no wind doldrums mid 80s? Looks unlikely, but we'll see where this week goes. I think geopolitics comes roaring back to the front pages. Year 2 of this war and what it signals may be what gives this market a new direction. Thank you. All the best.
Thanks a lot. See you guys.
Thanks.